Good evening, everyone. Now, I will still be passing this attendance around in case of those students who have not collected the card. So you can sign attendance here, okay? You just pass round and round until the end of the lesson. Okay, so do you still remember what we learned yesterday? I guess so, right? A lot, okay? And we started on looking at this tax computation format of a company, right or not? Yeah? Okay, I hope you have made a tag to this format because it's going to be quite frequent that we refer to this piece of paper when we do the tax computation of a company. Okay, we need to get ourselves familiar with this format first, okay? That is why I will be always going through this piece of paper with you again and again. All right, and the first starting point when we do tax computation is to start with the financial account, the figure, all right, from your financial account. That means the income statement. All right, basically the income statement is a figure that is, it's a piece of paper that we need to look at when we do the tax computation. This is income statement. The figure we need is the net profit before tax. And then after that, we do adjustment, right? And I have told you that basically our first objective is to obtain the trade profit. Anything that is not trade, we have to remove it, okay? So, by the way, this is on page 80, for those of you who just came in, right, page 80, part B, page 80, right? If you're lost, you can try to ask around and see whether you're on the right page or even if you're on the right class, in case there are some people who are in the wrong class, okay, after 2 lessons. Anyhow, right, okay, so yesterday I went through the basic, right? I said, how do we know whether the income is taxable, and after you know it's taxable, what adjustment you do, right? Okay, we will look at that later again. But towards the end of yesterday's lesson, we were looking at the batches of trade. Remember the batches of trade? First one is motive, second one is subject matter of realization, and so on. Okay, effectively there are 6 batches you need to know for exam purpose. We will look at one question later on to see how to apply, because you don't really need to meet all the 6 batches in order to confirm that it is trade or confirm that it is non-trade. All right, as long as one batch itself is strong enough to argue that it is trade or non-trade, you can use it to free yourself from being taxed. Okay, so we will look at that later on. All right, so basically we use that to help us to determine whether the income is a trade or non-trade. If it's non-trade, not taxable. If it's trade, it will be taxable. Okay, so that will be on what page? All right, if you still remember, that part is on page, part B1, page 1, right? Correct or not? Part B1, page 1, right? This one. We look at that again. We look at this already, right? Okay, and have you checked out my uploaded notes or not? All right, I just uploaded this afternoon because I got problem with the uploading. So I was trying to figure out since last night. Okay, but I managed to upload, all right? And I have also uploaded the court case, which I have discussed with you briefly yesterday, but do bear in mind that these court cases are not important for exam purposes, just for your reference, so that you will know how does this 6 batches of trade works, okay? Now, so let us move on to page 2. We are still looking at, 10.1a, because 10.1a itself, there is trade, there is a business, and then there is a, what else? Vocation and profession, okay? So we have not done with trade yet, okay? Now, if you were to look at this part, page 2, I'm not sure whether you can see or not. If you cannot see, just look at your notes, Right, I will try to expand a little bit here. Okay, this part here. Okay, now, this is a rule that is only applicable to ordinary shares. Right, if a company sells shares and they make a gain, is it taxable? This is only for ordinary shares, okay? So do bear in mind, if it is pertaining to disposal on other assets, you don't use this rule. This is what we call the non-taxation rule of ordinary shares, okay? Maybe I write it down so that you can see it. Right, this is actually non-taxation rule of ordinary shares. So if a company were to sell shares of another company and as a result they make a gain, is again taxable. So this rule will help us to determine whether is it taxable or not. So you have to meet these two conditions, right? So if it's a yes, then the gain is not taxable, all right? If you fail any of these conditions, then your answer is that the gain will be taxable, all right? So firstly, you ask whether did you hold on to the shares of these company for at least 24 months, all right? 24 months, that means it must be continuous. 24 months is roughly how many years? 2 years. So you must hang on to the shares of that company for 2 years. That means it's like a long-term investment, all right? If you hang on to at least 24 months consecutively, there is no break in between, then we can say that it is you meet this condition. Another condition is that you must hold on to the shares of the other company of 20% of shares of the other company. Okay, you must hold on. Or rather, okay, let me rephrase a little bit. You must be the shareholder of the other company, hold on to 20% of the shares of the other company, right? The rest of the shares is actually occupied by other people. So you must hold on to 20% of shares of the other company. So if you meet these two conditions, then you can say that when you dispose a share of this company, it will not be taxable. Otherwise, if you don't meet any of these conditions, it will be taxable. Then after that, what do you do? Okay, right now I want you to probably look at this. Let me draw this so that I can help you to understand what's going on. So remember, this is only for ordinary shares when you want to dispose ordinary shares. So firstly, you ask yourself, okay, step number one. Okay, step number one. Or rather, okay, let me write step number one. Step one. I think it's better not for you to see here. You can't see. You only see me. Okay, you sit there. Step number one, you find out whether the shareholding, do you hold at least 20% of the other company share? Right, at least 20%. It can be equal to 20%, but cannot be less than 20%. And you must hold on to the shares for at least 24 months. Okay? So if your answer is yes, the gain when you dispose the shares, right, will not be taxable. Okay? Okay? So if you fail any of this condition here, what will be the verdict? Because you need to meet two conditions, right? And, okay? If you fail, you cannot just straight away say that it's taxable. You still have to go through the what? We just learned it yesterday. We will need to apply the batches of trade to confirm again whether is it taxable or not taxable. Are you with me or not? So it's not a very clear cut that, you know, if you fail the test, then it's straight away taxable. All right. If you fail the test, they still give you a leeway out. All right. That is to apply the batches of trade to confirm whether is it taxable or not. Are you with me or not? Remember, this is only on ordinary shares. If you dispose any other items, you cannot use this, what we call the non-taxation rule. Okay. So with this, right, let me apply this understanding on a question, which is called Malville. Question number 1. Okay, once you're done with this, please help me to turn to question number 1 of the workbook. And there is a format given to you on the following page so that we can save some time, all right, on the copying. Okay, it is on page 21 of your notes, workbook, sorry. 21 of the workbook. Right? You have a workbook with you or not? Yeah, let me enlarge a bit. Okay, right now, so this is a company called Malville. Malville Private Limited, a Singapore resident company, was incorporated in 2011. So it was incorporated in 2011 as a manufacturer of diesel engine. So their trade is what? Their trade is to make diesel engine, right, for sale, right? So this is their Tier 1A, the trade, and its financial year end is 31st December. And Malville invested in the shares of a company listed on the Singapore Stock Exchange. The shares were acquired shortly after Malville was incorporated. So from this wording, can you tell me roughly when do you think Malville has bought the shares? From this wording, 2011, right? Or 2012, right? They're about correct or not? Because it says that the shares were bought shortly after Malville was incorporated. Some say 2011, some say 2012. I think it's fair enough. Okay? Now, and Malville sold these shares in July 2019. All right, so they sold 7 years or 8 years later, and they make a gain. So now we have to find out whether this gain will be taxable under the Singapore taxation rule or not. Okay, state the test that Malville will need to use to determine whether the gain realized from a sale of investment in 2019 would or would not be chargeable to Singapore income tax for YA 2020. Okay, now because this is pertaining to shares, right? You cannot directly go into applying the statutes of trade. You have to use the non-taxation rule of shares. All right, that means you have to ask the two conditions whether you meet the two conditions or not. Okay, so now you just have to gather the facts from the question and apply. Okay, if the question is not clear, then you state it's unclear and move on to the next step. All right. Okay, so step number 1, you apply the non-taxation rule. Okay, it's a shareholding. Malville, do you think they own a share of the other company of at least 20%? Did it say? No. It doesn't say. All right, it doesn't say. So it's a question mark. But did they hold on to the share for at least 2 years? Yes, right. Now, if the question is unclear, right, and you have to look at the marks given to you and see how much to write. Now, if it's a 5-mark question, you better write a lot more, okay? So you will need to explain the two sides of the story. You said, okay, so assuming if you pass the condition, all right, it will not be taxable, right? Now, because the question is very ambiguous, it's not very clear. If no, all right, you have to go through the statutes of trade to confirm, okay, whether the gain is trade or non-trade. Okay, so number 1, we look at the motive. The motive at the point of acquisition. Did the question tell you why did Malville buy the shares? Did the question state that? No. All right. So if it doesn't state, that means you can say that it is unclear. The motive is unclear. Yes, you can write things like that. All right. You say the motive is unclear. So you cannot use this batch to argue. That's why you can just write, oh, okay, no conclusion from this batch. So, low risk. Right? So this is how your examiner write in terms of the answer in the solution. Okay, I will tell you which is the exam question that has tested us on this before. All right. Now, what about subject matter realization? Now, when it comes to subject matter realization, we look at two things, right? We look at the nature of the item that is transacted, and we also look at the volume. Now, what is the nature? That means what is the thing that they have sold? Shares, right? Now, shares itself can be holding on for investment purpose, can also be for trading purpose. So it's very neutral. All right, it's quite. There's no clear, fixed kind of notion that, straight away it is trade. It can be trade, it can be for long-term investment. So, and also the volume itself, they did not say how much they bought, right? Correct or not? So if it's tremendous volume, then probably, the motive, all right, it is actually, trade related and so on. So again, it is unclear. The question did not tell us a lot of information pertaining to this batch. So if it's unclear, what can you say about that? No conclusion. Yes, this is something you can write, remember, okay, and hence it is low risk. That means the tax authority will not be using this to charge you for tax. Okay. Now, what about length of ownership? Do you think they hold on to the shares for long term? I think it's pretty long term, right? They bought sometime in 2011 or 2012, but they only sold in 2019. 19. So because of this, right, because of this fact, you can actually use it to argue that it is unlikely trade. Alright, so you just take the fact will do, just state the fact will do. So it bought in 2011 or 2012, if you want, you can put 2012, and sold in 2019. So because of that, it is pretty long term, right? So it is unlikely trade. What about the frequency of transaction? Did it buy, sell or not? No, alright. I only saw one transaction. Alright, so you can use this to argue with IRAS that it is also unlikely. It is trade. It looks like they will win, right? They will win the case, right? What about the supplementary work done? That means did you actually engage special skill people to help you to sell the share? For example, reminder, or shares, the dealer, those people who are very, very good in selling shares. Now, there is no information. Okay, you can write this down. If you know, you write. If you do not know what to write, you just say unclear. All right, no information on whether special skills were being engaged. Alright, so because of that, you say that it is no conclusion. So low risk. And last but not least, is there any circumstances that force them to sell? Is it because of a change in rule, that's why they are being forced to sell? They didn't say anything at all, right? Okay? Right, so again, this is unclear. So if it's unclear, no conclusion, no ending. So that is why, right, it's low risk. So that is all you will need to do when you see the question like this. You just apply 6 batches of trade to help you to determine. So from this situation, this case, right, it is quite clear-cut that I believe it can be argued that the gains from the disposal can be non-trade. So it should be non-taxable. Right, just go round and round. Because there are some people who came in. Okay? Alright, now if you want to see more questions like this, you can refer to your exam kit. You have your exam kit already, right? Okay, you can refer to December 2011 question 2B. Alright, that question is not on shares, that question is on property. Alright, so he sold a property, so you can use the batches of trade to confirm whether the gains are taxable or not. Okay, you can refer to that question to have a look. Alright, can? So that is your trade. Now, so we have to move on to the next item inside of 10.1a. The next one is your business. Okay, so let us move on to your part B1 notes. The next one is a business. Page 2, right? So what is business? Now, in fact, the word trade and the word business is quite similar. Alright, the word business actually represent more things, whereas trade is more specific to the kind of business or industry that you're doing. Right, so in real life or even in your examination, they tend to use this word interchangeably. Alright, so technically speaking, it is not much of a difference, okay, between the word business or trade. Okay, now what about profession? A profession is an occupation that requires advanced education or training. Now, who do you think is a profession? Who do you think, what kind of job do you think will require advanced education or training? Doctors or even lawyers, right? So, or even accountants, all right, people like you in future, if you decided to do freelance, all right, freelance, you know what is freelance? That means you are your own boss, all right, you do bookkeeping using your own name, all right, your income that you earn will be under 10.1a, okay? And last but not least, okay, just go round, yeah. Oh, sign already, huh? Okay, lor. Okay, so those of you who have not signed, thank you very much. Those of you not signed later on during break or end of the lesson, just help me to sign, okay, for the 3rd day. I was told to circulate this until the end of February. Right, so bear with me, okay? I also do not want this to be disturbing us, but no choice. Okay, so please forgive us on this. All right, now, yeah, that is profession. Okay, now vocation. Last but not least, what is vocation? Shall we look at the definition of what is vocation? Vocation refers to a strong feeling that one is specially fitted for a certain type of work or way of life. Special calling. What is it? What does it sound like to you? Some students say it's pastor, all right? I don't know, okay? But pastor, that means priest, evangelist of a church, all right, or ministry. But according to RS website, which I have seen in the past, they put taxi driver under the category of vocation. You know, taxi driver, right? Nowadays, we evolve into Grab driver. All right, please bear in mind in Singapore, I'm not sure how does other countries work. In Singapore, the taxi driver are self-employed, right? They are not employees of the taxi company, right? They are self-employed. So they basically, you know, you heard of company like Comfort, right? Comfort Taxi, all right? Other than Comfort Taxi, nowadays we have Grab. Okay, Comfort Taxi, basically the drivers, they are self-employed. They are not employees of the Comfort company. So taxi driver will be under the category of vocation, okay? However, all in all, we don't have to worry whether is it a trade vocation or profession and so on. As long as it's under 10.1a, the tax treatment is pretty much the same. Okay, you don't really have to worry about how to segregate them. Okay, the differences between them is actually quite minimal. Right, so that is a 10.1a. Right? Okay, let us move on to page 3. All right, I have to put this here because I'm not sure where to put it. That's why I put it here. Now, which credit scheme? How many of you have heard this before? Okay, it was introduced not too long ago. It's like in recent years. All right. Now, it is actually a scheme given by government, right, to sponsor the company who is willing to increase the wage of Singapore citizen. All right. So if the company is willing to increase the salary of Singapore citizen, the government will co-fund. All right. At the moment, it's about 20% of a wage increase. So in a way, the government is giving companies grant, right, or a subsidy, right, money. They give you money, right, to subsidize the pay increase. So when the government give you money or grant or subsidy, you have a revenue, right? Is this taxable or not? So all in all, we just need to find out whether the money given by government, whether is it in terms of grant or whether is it in terms of subsidy, is it taxable or not taxable? Okay, now as far as which credit scheme is concerned, right, this money that the business will receive will be subject to tax because it is to defray operating expenses. Salary, is it operating expenses? Yes, salary is operating expenses. It's revenue in nature. So it will be taxable. But sometimes the government may give you money to buy machine. Is a door closed? Because my voice will be very loud at times, you know. So it's better for me to close the door. Now, if the government give you money to buy machines are supposed to be capital in nature. Yeah, sometimes the government is very kind. They give you money to buy machine because, elections coming, for example. Okay, so it can be a lot of reason why government want to sponsor or give grant to a company. So if the grant is pertaining to purchase of machine, that is capital in nature. Such grant will not be taxable. So all in all, we just need to go back to the basic to ask ourselves whether the purchase is for what purpose. All right. Is the purchase for revenue in nature item? If it's yes, then the grant will be taxable. All right. If it's for purchase of capital in nature item, then it's not taxable. Okay or not? All right. So this actually summarizes the table here. Defray means to cover operating expenses like, you know, salaries and so on. Okay, salaries is revenue in nature, or even training expenses. All right, government give grants so that companies can sponsor or rather send their employees for training. Right? Training subsidy will also be taxable because it's revenue in nature. Okay? Can? Right, so this is revenue in nature and this is capital in nature. Right, clear? Okay, now if you turn to the next page, right, it is nothing new. It is an extract from your tax computation format. Okay, this is extract from a tax computation format. Basically, I told you, right, the first objective for us when we do the tax computation of a company is to obtain the 10(1)(a) income. So we always start off with the figure from the income statement, the net profit before tax, and then we do a lot of adjustment, right? Now, just to let you know that there should be something extra here. I have forgotten to add it in, all right? Less further deduction. I forgot to put it in. Okay, please help me to update it. All right? So we will not be looking at special deduction and further deduction today, right? Most likely we'll look at it next lesson. And next lesson, do you know when is it? Sunday again. All right, next lesson is Sunday. Yeah, bear in mind. Okay. So we'll look at further deduction and special deduction next lesson on Sunday. Okay, what we will be focusing on for the rest of today's lesson is this part. All right, non-deductible items. That means we will be looking at expenses. If a business incur expenses, are they deductible or not? So we have to look at rules under Section 14. All right, Section 14 of the Income Tax Act. Okay, all right, so hang on there. Now, how do we know whether expenses are deductible? Because as far as the company is concerned, as far as the business is concerned, they incur all types of expenses, right? So how do we know whether expenses are deductible? So on the next page, right, you will see these, what we call the general deduction rule. General deduction rule. If you want expenses to be deductible, you must ensure that all these three conditions are fulfilled. Firstly, is it revenue in nature? Okay, I think it is something which you should be well versed on. Okay, is it revenue in nature? If you are still unclear whether the expense, how is it considered as revenue or capital in nature, don't worry, later on we'll go through some guidelines. So if the expense are revenue in nature, all right, then it should be deductible. And it is incurred wholly and exclusively for the purpose of generating the income. All right, that means the reason why you are incurring the expense is because you want to earn that income. Right? And it is not specifically prohibited by Section 15 of the Income Tax Act. Now, Section 15 is the prohibited section, right? Okay, now let me tell you a little example of Section 15. Now, Section 15 is a whole list of expenses that is not allowed for deduction. Example, private expenses of directors, private expenses of owners. Right, private expense, for example, you're the owner of the business, you take money from your business and buy a handbag for your wife. Is it private expenses? Obviously it is, all right? It is not deductible, okay, because it's prohibited by Section 15. Right, private or personal expenses not deductible. So ultimately, Section 15 is the most powerful. Why? Because even if it is revenue in nature, even if it is incurred for the purpose of generating income, if Section 15 say cannot deduct, straight away cannot deduct. We will look at a list of Section 15 items after next week. Okay, we will look at that, a whole list. All right, that is more commonly tested in an examination. Okay, now, so next page is to determine whether the expense is it capital or revenue in nature. By the way, am I going too fast? Okay, the speed, can all right, if I'm too slow, you will fall asleep, definitely, yeah? Okay, so if it's revenue in nature expense, then we can say that it is deductible. If it's not, we say it's capital in nature, then it's not deductible. Okay, B, that means deductible lah. Okay, so now these are guidelines only, okay? So when you are being presented a scenario, basically you will have to apply this guideline to see whether you can conclude if it's a capital or revenue in nature. Okay, so A, expenditure incurred for which benefits are enjoyed once. That means the benefit is not long lasting. Okay, for example, you spend $100 on petrol for the van. Alright, do you think that $100 expenses that you incur on the petrol, do you think the benefit is long lasting? Not really. 1 week later, oh, the petrol oil is up. Then you have to pump again, right? So it sounds like recurring to you, right? Yeah, so this $100 should be deductible because it's considered as revenue in nature. Alright, however, okay, if you were to look at the side, expenditure incurred for which benefit obtained is of a lasting or enduring nature. That means the benefit you obtain is of an enduring or long-term nature, then it should be capital in nature, not deductible. For example, you spend $100,000 to buy a van. Right? The benefit is because, okay, the benefit is what? You spend $100,000. The benefit is what? You got a van, right? You got to use it, right? So do you think the benefit is long-lasting? Pretty much, because today you buy the van, will you throw it away tomorrow? No, all right? You will hang on to it for long term. So we say that the benefit when you spend this $100,000 is quite long-lasting. So the $100,000 will be capital in nature, not deductible. Okay. However, if you buy a capital in nature item, you may be allowed to claim capital allowance, which we'll cover in about 3 lectures time. Okay, so that is the first. That's part A. Okay. Now part B and part C, I would say that it is pretty similar. So I will combine these two to help you to understand the differences between revenue and capital in nature. All right. So firstly, you ask whether the expenditure is it recurrent. Recurring, that means is it frequent? Is it ongoing? Right? Is it recurring? Is it ongoing? All right. If yes, then it's revenue in nature, is deductible. All right. If it's non-recurring, if it's a one-off kind of expenses, then unlikely it is deductible. Okay. Now, I'm going to use one example to help you to really understand what I mean by one-off and what I mean by recurring. Okay. So, for example, now it is very common that in exam you will see country club expenses. You know, country club. Sometimes company they want to be members of country club. Right or not? For what purpose? You know what is country club or not? Why is it that company want to be members of country club? So that they can bring their business clients to do what? Play golf. You know, country clubs are those places that you can play golf course, all right, and the driving range, right? Okay. Now, in order to be a member of country club, you need to spend a lot of money. You need to be a member. Okay, so to be a member, firstly, you will need to pay annual subscription fee because you are using the facilities. Then you may even need to pay an initial fee to join as a member. All right, so there's an annual fee and then there is a one-time joining fee, right? Okay, the annual fee, it is going to be considered as recurring, correct or not? All right, so annual fee, annual subscription fee will be under the category of recurring. So it will be capital in nature or revenue in nature? Revenue in nature. So subscription fee of country club, because you are using the facilities, it will be deductible. But if you see words like entrance fee or joining fee, all these are what we call the one-time fee. Alright, one-time fee. It should be classified under capital in nature, so it will not be taxable. It will not be deductible. Okay? Okay? Alright. Now, lastly, okay, part the expenditure incurred to continue the operation of an enterprise versus expenditure to bring in a source of income. Okay, so we look at the first part, expenditure incurred to continue the operation of an enterprise. Now, do you think Kaplan owned this building? No, right? We actually is the tenant of this building. We pay rental. We actually sign a rental lease, right? Let's say we sign a 5-year rental lease, and after 5 years is up, right? We have to do a renewal, correct or not? Renewal. So when you do a renewal, you may need to pay a legal fee on the renewal, correct or not? Okay, because we need to engage lawyers to help us on the paperwork. So legal fee on renewal of rental lease, right, will be under this category. Okay, when you renew the rental lease, you will need to pay legal fee because it is expenditure incurred to continue operation. We have to pay money to continue running operation, so therefore it will be considered as revenue in nature. However, if I said that it is a legal fee on a new lease, maybe we want to get a new place, we have not been to the place before, we want to get a new place, a new lease. Legal fee on a new lease will be capital in nature, all right? Legal fee on new rental lease will be capital in nature. Yeah? Okay, so these are just some guidelines to help you to determine whether the expenses that you're presented with is it capital or revenue in nature. Okay? Right. Okay, so let us move on. Now we are going to look at some expenditure that will be common in examination. So we will be moving on to section 14. Section 14 is your deduction rule. Alright, just some pointers for you to take note. Expenses must be incurred in the relevant basis period by the taxpayer. Okay, now what does it mean? That means if you are looking at basis period for YA2020, and let's say this company has the December year end. December year end for YA2020, what is the basis period? First of? Yes, right, just to recap for some students. So only when you incur expenses during this period, then you will determine whether the expenses is it deductible or not. So you still have to look at the basis period, all right? Now the word incurred, must it be already paid? No, all right, not necessary. That means you have a liability to pay. You may not have already paid, all right? So it could be a payable, right? But then you will still be allowed to deduct. Okay, it is revenue in nature and it is not prohibited by section 15. Now the whole amount of expenses must be solely incurred for the purpose of generating income. Only the portion of expenses that is incurred for the purpose of generating income. Okay, what exactly is this? Don't worry, I will use one example to help you to understand. Okay, what is mean by only the portion that is incurred is deductible. I will explain to you shortly. Alright, so first thing first, let us look at section 14.1a. Let us look at section 14.1a. Okay, so this is on page 8. Are you there? Interest expense. Now, can you tell me, when will you incur interest expense? When you borrow money from banks, right, or even from other people who has the money, who has a surplus fund. So as a result, you incur interest. Now, I don't care whether is it long-term or short-term loan. Interest expense is actually deductible, right? Because it's recurring. Now, the only question is, what is it deductible against? Because you have various income, right? The reason why you want to borrow money is because you want to earn income, all right? So the key question to ask for interest expense is, what is it deductible against? That is why you have to look at the purpose of the loan. The purpose of a loan. Now, what do I mean by this? Don't worry, let me give you an example. Purpose of a loan. Okay, so this is for section 14.1a. Right, section 14(1)(a). Let's say you have loan A. All right, you're a company, you borrow loan A, $1 million. All right, and as a result, you incur interest expense of $10,000. Let's say interest expense is $10,000. Okay. All right. So you borrow this $1 million to buy a machine. And this machine is to help you to earn trade income because you are in the business of manufacturing. So the purpose of a loan is to help you to earn trade income, right? So therefore, this interest expense will be deductible against your trade income. Okay? So let me write down this interest expense. All right, will be deductible against your section 10(1)(a) trade income. Right. Now, then what if I now present to you another loan called loan B? Same company, they take up another loan, but this loan, let's say is 1.2 million. Okay, and let's say the interest expense is, 12,000. Okay, it can be any other figure, right? Let's assume that it's 12,000. So this 12,000, okay, you borrow this money is because you want to buy a property. And this property, you want to buy it because you want to earn what income? You want to rent out. So you want to earn what income? Yes, you want to earn rental income. So, okay, now, for your information, if you can't remember what rental income is under 10(1)(f). So this 12,000, all right, the purpose of the loan is to earn rental income, right? So this 12,000 will not be deductible against trade income. It will be deductible against what income? The rental income. All right, so therefore, what I'm trying to tell you is you have to match the expense to the income that is producing it. All right, are you with me or not? So therefore, when you do the adjustment, assuming that this $12,000 expense is already inside your net profit before tax, but since it is not deductible against your trade income, so what must you do first? Let me write down. Since you know that it is not deductible against your trade income, what must you do first? Not deductible, what adjustment do you do? You have to add back first. You have to add back the 12,000 interest income. Yesterday we talked about the deduction adjustment, right? You have to add back the interest expense. Alright, it's only when you look at the rental income, then you will less out against the rental income. But I told you already, initially what we want is the trade income. Alright, so anything that is non-trade, you have to remove it. That is why you have to make this adjustment. So you have to add back 12,000 interest expense. You will only deduct much later on when you are handling the rental income. Are you with me or not? Okay, I will try my best to help you to see the bigger picture, but it takes time. So if you have problems seeing the whole picture, let me know. Okay, I can explain to you again and again. Okay, all right. So, okay, coming back to this. However, do take note that, all right, interest expense is not just, the loan and then there's an interest expense. Now, sometimes in order to obtain a loan, you may need to incur borrowing costs. You may incur other borrowing costs, all right, borrowing costs. For example, in order for you to get a loan, you may need to get a guarantor, right? Why is it so? Because maybe your credit rating is not very good. You will need to get a guarantor to help you to secure a loan, or maybe the guarantor has very good credit rating. All right. So let's say you manage to get a guarantor, but sometimes you will need to pay guarantee fee. All right. Nothing is free in this world, right? Right? You need to pay a guarantee fee. Now, the guarantee fee usually is a one-time fee. So if it's a one-time fee, what does it sound like to you? Capital in nature or revenue in nature to you? Capital in nature, right? So by right, expenses like guarantee fee one-off is capital in nature, not deductible. But there's a concession. Alright, concession says what? That means if such borrowing costs like guarantee fee can help you to reduce your interest expense, alright, or it can be substitute for interest expense, then such guarantee fee, alright, or similar borrowing costs will be deductible. Alright, maybe because the guarantor has very good credit rating, that is why you're able to secure a loan with lower interest rate. As a result, you can get lower interest costs. Yeah. So the question will definitely tell you whether does it help you to have a reduction in interest costs. Alright, if it is, then such borrowing costs will be deductible. Alright, there is a whole list of interest costs or rather borrowing costs I've included inside Appendix A, but one common will be guarantee fee. Okay? And the last one, okay, let us take a step further. Last one is on refinancing. Oh, what is refinancing? You know what is refinancing? That means you take up a second loan to finance the first loan. Why would you do so? You got nothing to do, so you buy another loan to service the first loan. Is it? No. Usually the reason why people do it because the interest rate is better. Alright, so you want to get the second loan to pay off the first loan. Okay, so for those of you who are not very familiar with this, alright, but in future if you were to buy car or buy house, you will find yourself always looking for refinancing. Okay, let's say many years ago, let's say in 2014, okay, can be any year, the interest rate is 15%. Okay, and you borrow loan number 1, okay, to buy a machine. Now, this machine is to help you to earn 10(1) income. So therefore, the interest expense on this loan obviously will be deductible against your 10(1) income, right? Yep. And then for some reason in 2019, you actually took up loan number 2 to pay off loan number 1. We call it refinance. Okay. Now there will be interest expense from loan number 2. But technically speaking, this interest expense, it is not directly linked to generating 10(1) income. Alright, this interest expense is not directly linked to generating 10(1) income. By right, IRAS will not allow you to claim deduction on this interest expense. However, if you are able to prove to IRAS that you have commercial reason why you want to refinance this loan number 1, then you can claim a deduction on the interest expense against your trade income. Now, what will be the example of commercial reason? You must have genuine commercial reason. That means you must prove to IRAS that you're doing it because of what? For example, you want to achieve a lower overall reduction in the cost of finance. Alright, maybe, now the market situation is different. Right, the interest expense is only 5%. Then I think it is quite worth it, right, to refinance, right? Because you will save on your interest costs, correct or not? So this is one of the reasons why IRAS will allow you to claim a deduction on the interest expense from a loan 2, even though loan 2 is not acquired for the purpose of buying the machine. Okay, or it is necessary due to the taxpayer financial position. Maybe the business is having a financial problem, they cannot pay off the loan. So even if the bank sue them, also no use because the company cannot pay one. Alright, so because of that, probably the bank repropose another longer loan, right, to refinance the first loan. Okay, so if there's a reason, then probably you can use it to argue, and then your interest expense on the second loan will be deductible. Or maybe the first loan, the previous loan expired, but you have no money to pay the capital, so you can do the refinancing. Alright. So this will be a situation whereby the interest on the second loan will still be deductible. Okay? And so please bear in mind, interest expense is not just looking at the interest. You have to look at other expenses, all right, which is what you will see here. Okay, now let us look at a question. Look at the question. All right, now I want you to take about a minute to go through this. Question number 23, or page 23, question number 2. Take a minute to look at this question to see whether you can do it or not. All right. Please excuse me for a while. I need to go to the washroom. Okay, just 1 minute. Okay, 1 minute's up, right? So do you have the answer? All right, bank overdraft interest. Do you think it sounds like trade or non-trade? Remember, interest expense revenue in nature is deductible. All right, now the question is whether is it deductible against your trade income, that means your 10(1)(a) income. All right, so do you think overdraft interest, this bank overdraft, that means a short-term loan, right? All right, is it for trade purpose? Yes. All right, it's usually for trade purpose because bank overdraft is your your current liability. All right, it is actually part of a working capital. All right, your CA, CL, you know. Right, your working capital. So it is trade related lah. What am I writing? Yeah. Working capital. So it is trade related. If it is pertaining to your trade, so this expense will be deductible against your trade income. So if it is deductible, can I just write D? D stands for deductible, okay or not? So if it is deductible, what adjustment do you do? Do nothing. That means no adjustment. All right. If I missed yesterday's lecture, try to catch up. All right. Give me a text or email me to find out how you should go about, getting yourself familiar with the adjustment. Adjustment is very important. Okay. Right now, interest on loan to buy machines, machinery. So is it okay? You buy machine is because you want to earn what income? trade income, right? So it's related to your trade income, your 10(1)(a). So do you think it's deductible? Yes. So therefore, again, no adjustment. What about the third one? So far, so good or not? Have you got your answer correct? Okay. Interest charged by inventory suppliers for late payment. Oh, what exactly is this? Okay. That means you who buy from who? You are the business. You buy or you sell? You buy from a supplier, right? What do you buy? Inventory. You buy from supplier, and because you pay them late, they charge you interest. Is such interest deductible against your trade income? Yes or no? The answer is yes. Alright. It is like the supplier lend you money to buy inventory. And what's more, inventory is trade related, right? Correct or not? This is actually the giveaway. Alright, this is actually the most important part that says that it is revenue in nature, is trade related. Alright, so therefore, this is no adjustment. Now, what if I turn the table around? I said that you sell to your customer on credit, but because the customer did not pay you on time, you charge them interest income, right? Right? Possible, right? So the interest income that you earn from the customer, that interest income is actually a 10(1)(a) income because it's linked to your trade. So you might want to take note because I have seen this appearing in exam a few times. So that interest income is not the 10(1)(d) non-business source income. That one is considered as a business source income. It's sourced from your trade. It's a 10(1)(a) interest income. Okay? All right. I'll remind you again when we do a question like this. Alright, the next one, interest on overdue CPF. Ladies and gentlemen, what is CPF? What does it stand for? Anyone? Central Provident Fund. Okay, now if you're not familiar about CPF, not to worry, we'll look at one topic on CPF later on. Basically, it is like a pension fund. Okay, in Singapore, because in Singapore, if you are a citizen or PR, you have to contribute to your pension fund, right? Yeah. So what happened is this. Interest on overdue, that means you are paying CPF late, right? Yeah. Who is CPF? Government, right? If you pay money late to government agency, whose fault is it? It's your fault, correct or not? It's an offense, you know? It is an offense. So do you think they will allow you to claim a deduction on your offense? No. If they allow deduction, that means they are encouraging you to pay late. Okay? So late interest charges or even traffic fines, you know, summons, right, that is given to you from traffic police or even other government agencies, such expenses are not deductible. Okay, if it's not deductible, yet you have already deduct from your P&L, what must you do? Very good, you add back. Okay. Okay, moving on. Interest on loan to buy shares of an ABC Limited. To date, there is no dividend issue. Okay, assuming that this is a normal trading company that is making and selling goods. Okay, and dividend income, it is the investment income. So dividend income, is it a trade or non-trade? Non-trade, right? So the interest on the loan to buy the shares will definitely be not trade related. This is the 10(1)(d) income. So if you incur interest expense to earn this income, it will be only deductible against a 10(1)(d) income. But since there is no income yet, so you cannot claim a deduction. So you have to add back. It is not deductible against your trade income. You have to add back. It is only deductible against your dividend income if there is any. The last one. Interest on loan to finance the purchase of an apartment which was rented out since last year. So it is something like the illustration I've given to you. Okay, you borrow money to buy an apartment so that you can earn what income? 10(1)(f) income. Now, this interest expense will only be deductible against your 10(1)(f) income. So, it will not be deductible against your trade income. So, for the time being, you have to add back. Okay? So, not deductible, you have to add back. Alright, you will need to bear with me and go through with me all this basic before you can do a full computational format of a company. Alright, and we are only on the first one, that means section 14(1)(a). Let us move on to the second item. Alright, by the way, the question 3 can do as homework. Right. Question 3, part A is to ask you about the 3 general deduction rule. Alright, what is the 3 general deduction rule? Firstly, expenses must be revenue in nature. Secondly, expenses must be incurred wholly and exclusively for the purpose of generating income. Thirdly, it must not be prohibited by section 15. Alright, if you can write it out and then give an example, then you can get the 4 marks. And part B is on refinancing. Alright, they want you to explain under what situation will be interest expense that is incurred by refinancing loan is deductible. Alright, so you have to spell out those commercial reasons when is it deductible. So everything you have to understand, and then nearer to the exam date you have to memorize, and then on the exam date you just regurgitate out like that. Correct, well, this is exam, right? Alright, no point memorizing now because you will surely forget. So try to understand first. Then nearer to the exam date, you will try to memorize that. Okay? So main thing is try to understand first. Okay, let us go back to your notes. Section 14(1)(b) is a rental expenses. Rental expenses, you spend expenses on rent. Okay, when will you incur rental expenses? We say 2 possibilities. For example, Kaplan, right? We rent this place, right? We incur rental expenses, right? Is it deductible? Yes, because we need this space to earn the trade income, money, trade income. Alright, now what about sometimes a company may rent apartment for the expatriate employees, right or not? Alright, now it's a staff benefit, right? So is such rental expense on apartment deductible against the trade income? Yes or no? You understand the situation that I'm trying to explain to you, right? Now, for the second situation, it will still be deductible. Because the reason why you want to employ employee is because the employee is to help you to earn what income? Trade income. So, the staff benefit that is given to them, right, if you incur expenses, for example, rental on their apartment, will still be deductible. Okay? Alright, so let us look at the question. We have a question on that. Come. On page 24. Rent incurred 100,000. Okay, look at the number 2. Number 2 is easier. We will look at number 1 later on. Rent incurred for apartment for an expatriate employee. Is it deductible? Yes, it's deductible against a trade income. So therefore, no adjustment. No adjustment. Okay, now let us go back to the number 1. Rent incurred 100,000, of which 80% is for the use in the business operation and the balance 20% you sublet to another business. Oh, what does it mean? So for example, you have this space here. Alright, you incur 100,000 to rent this space. 80% of this space is for your business. So it's to earn 10(1)(a) income. The 20% sublet, that means you rent it out to another business to earn rental income. Alright? You sublet it out. Sublet, that means you rent it out to another business. So how much will be deductible against your trade income? The 80% obviously is for trade, right? So the 80% will be deductible against the trade income. However, the 20% of the 100K will not be deductible against the trade income. The 20% will be deductible against the rental income. Are you with me or not? So it's just matching. Tax is like that only. Not very complex, right? Yeah, just match the expense to income. Okay? So end of the day, you have to add back how much? 20,000. Because 80,000 is deductible, no adjustment. The 20,000 you have to add back against your trade income. Okay, let me write down here. The 80,000 not 80,000 is deductible, so no adjustment. The 20,000 not deductible, so you add back. Okay? So that is a 10-1. Sorry, section 14.1b. Section 14.1c. This is a pretty common expense that can be incurred by businesses. Okay, repair and renewal expenses. Let's look at repair, the word repair. Now, what does the word repair mean? For example, if let's say I said that, you know that thing, projector, spoiled. Not now, now cannot spoil already, I hate it. After 10 o'clock, spoil. So after it's spoiled, I will send for repair, right? Alright? And after it's been repaired, return to me, will this projector be a more superior projector? No, it will still be the same projector. I'm just trying to merely revert it back to the original working condition. So there is no element of improvement. Alright? That means it will not become bigger when it return to me, right? So there is no element of improvement. Alright? So it will be revenue in nature. So repairing, maintenance, all these is revenue in nature. It will be deductible because you are only merely restating it back to the original working condition. However, if you spend repair costs, alright, on second-hand asset before you start to use it. Let's say you bought this. What is this? A car? Van. Looks like a van to you, right? Not a car? Okay, let's say you bought a second-hand van, but you have not used it yet. Second-hand what? You have to make sure that it is in good working condition, right? Before you can use it on the road. Otherwise, the brake spoiled. How? Cannot stop. Alright, so if you were to incur any repair expenses to ensure that this second-hand car is in good usable condition, such repair expenses will not be deductible. Alright, it's capital in nature because this car you have not used it to help you to earn income yet. So the initial repair expenses on this second-hand asset will not be deductible. So you have to read the whole question to see what is the situation before you can conclude whether the repair cost is it capital in nature or not capital in nature, because this will be considered as initial repair cost, capital in nature, initial. All right. Now what about renewal? What does renewal means? Renewal actually refer to what? Replacement. Okay, replacement of whole asset. Replacement. That means you replace asset. Replace asset. That means replacing tables and chairs. Not really. Okay. Now, for example, I want you to imagine that we are in a restaurant business. Now, in restaurant business, you will need to use a lot of what? Plates, bowls, alright, chopstick and all this, right? The plates and bowls, on your hand, you quite accept. The moment you drop them on the floor, bing clang clang, it becomes liability. So these are what we call asset of short lifespan. Alright, if you were to replace asset with short lifespan, replacement of these asset, you spend money will be deductible. Short lifespan. Okay? For tables and chairs, it's a different thing. Because tables and chairs, I don't think it's short lifespan, right? Okay, it's of quite durable lifespan. So I'm not referring to tables and chairs. I'm referring to asset with short lifespan. So if you're looking at manufacturing company, I will think that, those tools that you use, like pliers, screwdriver, nuts, bolts, all these I think are considered as asset with short lifespan. If you replace them, it will be deductible. Okay? Can? Alright, so this is the first category. Now the second category, I will not want to explain to you now because you will learn it much later on under part B3. So can I keep in view first? Can I hold on to it first? I will revisit this part again when we look at section 10.1F rental income. Okay, because if I were to introduce this to you so early, you might not be able to understand what's going on. Alright, so we hold it first. Okay, look at question number 5. Question number 5. Right, so imagine you are in a manufacturing company. You're trying to find out whether the following expenses are deductible against your trade income or not. Okay, your section 14.1c. Okay, by the way, must you memorize all the section number? I have not asked you this question, right? Must you memorize all the section number? If you can, memorize that. If you cannot, then don't write because you'll make mistake and then the mistake will make you lose marks. Okay, if you can, remember it, especially if you want to really have a career in the tax industry. All right, it's good to memorize all the section number because your Singapore Income Tax Act is going to be your Bible. Okay, it's the source of the tax rule. Okay, you spend money to maintain factory building. Is it deductible against your trade income? Yes. All right, maintenance. There is no element of improvement. No adjustment. All right, now then repairs of production machinery, is it deductible? Yes, because it's quite normal that you repair machine, right? Repair, all right, there's no element of improvement. You're merely trying to restore it back to the original working condition. Renovation? Renovation. Now, I think you have seen this word in your financial account before, right? When you spend money on renovation, usually you will capitalize the expense, correct or not? Yeah, so in tax, we will also treat this as capital in nature because there will definitely be some element of improvement. Otherwise, you renovate for what? Alright or not? If there's no element of improvement, you will not want to spend money to renovate, right? So, as far as renovation is concerned, usually that comes with an element of improvement. So, it will not be deductible. It's capital in nature. So, if it's not deductible, what do? Add back. Thank you very much. Okay, replacement of loose tools. Yes, because short lifespan. Okay. Except short lifespan. Okay, now let us imagine that you are in a hotel industry. You repaint office. Any element of improvement? Will the office become bigger? No, all right. So you can claim a deduction on this. Okay, deductible, no adjustment. Repair to photocopier machine. I think it's quite common that businesses have photocopying machine, right? All right, it's for the business. All right, so therefore it will be deductible, no adjustment. Replacement of cutlery and linen. All these are except with short lifespan, right? You tend to replace them quite frequently, so it will be deductible. Okay, except with short lifespan. Okay, property for generating rental income. It is a 10(1)(f). So remember, we're trying to find out whether these expenses is deductible against your trade or not. Okay? You install aircon, you replace 40 aircon, all these are not deductible because it is not for the purpose of earning your trade income. So it's not deductible, you have to add back against your trade income. Alright? Can everyone? Okay, let's go back to your notes. Shall we look at the next part, which is on page 10. Page 10. Okay, bad debts written off and specific provision for doubtful debt. Okay, it's not going to be difficult, alright, because there are some change in the rule and then, they make it easier for us in the recent exam sitting. Okay, now, so you're a business, you sell to your customer on credit. So does it mean that your customer has paid you already? Not yet. Alright, if your customer pay you, great. What if a customer is bankrupt? What will happen? If a customer is bankrupt, are you able to get money from are you able to get back money from them? No. So what must you do as an accountant? You need to recognize it as a bad debt, right? Bad debt written off, correct or not? Okay? So, do you know that bad debt, you will charge it as an expense in your P&L? Is it deductible? So this is a question that I will want to go through with you. And sometimes, you may not be bankrupt. Sometimes you are just, because as accountant, you need to be prudent, because you hear the market is not very good and you foresee that there are some percentage of your customers who may not be able to pay you. So therefore you need to make what? Provision. Now for those of you who have studied ACCA, the earlier paper, you have hear things like specific provision and general provision, right? So whenever a business make general or specific provision, all these will be also recognized as expenses in a P&L. Yeah, so will such expenses be deductible? So we have to look through all this, right? So expenses will be deductible provided the following conditions are met, okay? The debt must be a trade debt or business. That means it's a 10(1)(a) debt. Okay, so if it's a 10(1)(f) rental debt, that means the tenant is not able to pay the rental. That one is a 10(1)(f). It's non-trade. That one you cannot claim a deduction because IRAS say that it must be what? Trade related. And it is part of a trader's income. That means the figure that you are trying to claim a deduction is actually arising from, okay, so when you sell, okay, you will debit your trade receivable, right? And then you credit your sales, right? Correct or not? Okay, I'm not trying to confuse you with double entry I'm just trying to come up with simple double entry. So the figure must be from this sales account. Okay, it must not be from any other account. This is what they're trying to say here. And the debt is irrecoverable or estimated to be irrecoverable in a basis period. Irrecoverable, that means you cannot get back already. You want to write off. Estimated means you want to make a provision. Okay? Controller, CIT means controller of income tax. You will see in the earlier section. Is satisfied that the debt is irrecoverable. That means you have tried your best to try to get back the money. Right, from your customer, you send reminder letter, you send warning letter, and then you send legal letter. Yet you still cannot get the money Okay, right? So you have tried your best to get back the money, but you cannot get back, and finally you want to write off. So, IRAS must be satisfied that you have You have done all this. And main thing, you cannot continue to do business with that customer unless they pay using what? Cash on delivery. Then maybe, all right, it is still possible to have subsequent dealing with them. Right? If you write off the debt already, then you still continue to do business with them, then others will think that, you're not really trying your best to get back the money. Okay? And now, just now you mentioned about general provision, right? General provision is not deductible. Specific provision is deductible. Specific means what? That means you are able to identify the particular customer who may not be able to pay. General provision is only based on a certain percentage. That one is not deductible. Okay? General provision are deductible. Specific then is deductible. Now, however, because of some changes in rules, right? Okay, I will explain to you what is Section 39 and what is Section 109. Have you heard of Section 109? Okay, never mind. Okay, let us look at a question here before we look at your FRS 39 and 109. Okay, go to the question. Oh, question number 6, you can read it on your own, is on renewal expense. Okay, it's a theory question. You can try to, the answers are at the back, so not to worry about that. Okay, now look at question number 7. So if I've written off trade debt, is it deductible against your trade income? Yes, because it's trade debt. Hence, it's deductible. If it's deductible, what adjustment do you do? No adjustment, correct. Non-trade is not deductible. So, add back. Okay, now, what about the third and the fourth item? Recovery of trade debt. Means what? Is it expense or is it income? Income already. You cannot say whether is it deductible. That means after you write off the debt already, suddenly your customer appear in front of you and say they can pay you. Troublesome, right? Okay, so that will be income to you. Alright, recovery of bad debt is an income. Okay, you debit bank, you credit your bad debt recovery, right? Okay, so that one is an income. Income, you will ask whether is it taxable or not. You cannot say whether is it deductible or not. It is whether is it taxable or not. So recovery of trade debt, is it deductible? Oh, sorry. Okay, is it taxable? Yes, because previously if you write off, it's deductible. Now when you get back the money, IRS want it back from you. So it will be taxable. Fair, right? Logic, right? Okay, previously they allowed you to claim a deduction, Now when you get back money from a customer, they also want the money back from you, so it's taxable. Alright, so if it's taxable, no need to make adjustment. Okay? Then recovery of non-trade debt, is it taxable? It is also not taxable. You just follow the pattern, If it's not taxable, but already inside your P&L, yes, you will take it out. You will less it out. Because it's not taxable, so you less it out. Alright, now, then we look at provision. Now, provision, we will increase or reduce. Okay, if it's a increase in provision, it will be considered as expense. If it's a reduction, it is like a reversal of expense, so it is deemed like an income. Okay, so again, if it is expense, you will ask whether is it deductible. General provision, is it deductible? It's not deductible. So you have to add back. Specific provision will be deductible, so no adjustment. Okay, now then reversal of provision, decrease of provision, taxable or not? Decrease in general provision will not be taxable, so less out. It is quite similar to the one on top, right? Okay. This one will be taxable, no adjustment. You need to try to figure out and try to rationalize it. Okay? Think it through. If you can't understand, let me know. Because it's something very new to you. Alright, just now I talked about section 39. But not section 39, sorry, FRS 39. Have you heard of FRS 39? Now FRS 39 is actually being replaced by FRS 109. Alright, for those of you who are doing audit and assurance, you will know about FRS 109 is replacing FRS 39. But not to worry, because your examiner is not a FRS person, right? So the way he tests you is not going to be so sophisticated, okay? You are not expected to write out the FRS standard lah. Okay, you just need to know, all right? Because of the introduction of FRS 39, you will not do provision. Instead, you will do impairment testing. Okay, right? So if you do impairment, it is either you will end up having an impairment loss, or it will be a reversal of impairment. If it's an impairment loss, you will charge the P&L, right? The next question is whether is it deductible or not. Impairment loss, is it deductible or not? Now, when will impairment loss be deductible? Is when the impairment loss is done on revenue account. Now, I think you would have roughly heard of this word called revenue account. Revenue account, you have heard it in your financial accounting. Revenue account will be things like your debtors account, that means a trade receivable account, your inventory account. All these are revenue account. So if you do impairment on your revenue account, like for example, your inventory or trade receivable account, all these will be deductible. Conversely, if you do a reversal, that means it is like an income already. It will be taxable. Okay? So nowadays, impairment gain or impairment loss is very straightforward. As long as the impairment test is done on revenue account, it will be revenue in nature, taxable and deductible. Okay, so that is actually the part on okay, let me look at 109 because 109 has replaced 109 has replaced 139. You can read the detail, but you don't really have to understand 100%. Okay, basically you will do impairment on revenue account. Example, your inventory or your trade receivable. By the way, you don't need to do impairment on trade payable. Because if you owe people money, the other person will not tell you not to pay, right? You will only need to do impairment on trade receivable. You don't need to do impairment on trade payable. Correct or not? You know what I mean. Okay. So if it's impairment loss on revenue account, it will be deductible. So you can see the table before that. If it's a reversal, it will be taxable, provided the test is done on revenue accounts. Okay, so let us look at the question left behind before we go for a break. Okay, let us look at this question. Okay, loan. Okay, what is this? Loan to employee written off. So we actually widen the scope a little bit. All right, loan to employee written off. Is it deductible? If you were to strictly look at the condition that you see on page 10, do you think the loan amount is part of the trader's income? Is it from the sales figure? No. All right. So strictly speaking, IRAS will not allow you to claim a deduction. Okay? So if you see words like this, please say that it is not deductible. Add back. Alright, because it's not a trade debt. You are not in a business of lending money to people. It's not your trade. Impairment loss on trade debtors. That means a trade receivable. So trade debtors is a revenue account, right? So would it be deductible? Yes. So your adjustment will be like this. Very straightforward. Recovery of trade debt written off previously. This is something that we have done earlier, nothing new. Recovery then is income. You ask whether is it taxable or not. Is it taxable? Yes, because it's trade related. So no need to make any adjustment. Okay, then what is the next item? Okay, the next item may be something that it is pretty new to you. You may not have learned this before, but I just want you to remember, okay, in the event if it ever appears to you, just remember, trade debt taken over from an associate company written off. That means the debt doesn't belong to you, right? The debt belongs to someone else. Maybe you take over the other company, so you put in the debt. Then later on you write it off. Is it deductible? The answer is not deductible. It's a tax rule, so just remember for now. Okay? So it's not deductible. You add back. You just remember that it's because it's not your own debt. It is someone's debt. So if you write off on your own, it is not deductible. Alright, just remember this rule. Now, reversal of impairment loss on trade debtor. Is it an expense or is it an income? It's an income reversal. It is like a deemed income, right? Alright, so it's taxable because it's on a revenue account. So is it going to be any adjustment that you need to make? No adjustment. So that is about it. Then let's take 15 minutes break. We come back to do CPF.